All right, guys, let's run through the FOMC then. Now, just a quick heads up, I'm planning to trade this one tonight and run through it with you guys, but I have been up since 5 a.m. local time, and FOMC is only taking place at 4 a.m. my local time. So assuming it's eventful and it's tradable and we have the press conference taking place, which usually takes about 90 minutes in total, and that's obviously 30 minutes after the official release, it's gonna be an all-nighter for me if I do that. So I do hope that I make it. I am pretty tired at this stage, and if I don't make it, I am sorry, but at least you guys will have the preview. And the community, I mean, you guys are on fire with great insights. So if I do fall asleep, I know you guys will be okay. So let's get stuck into the FOMC then. As always, let's start with what is expected for today. If we take a look at rate expectations, there's absolutely no expectations of any change in rates. The Fed is expected to leave rates unchanged. On the quantitative easing side, there are growing expectations, and I think this is now the baseline, that the FOMC will announce a reduction in the pace of their balance sheet runoff, potentially to start from June at about a reduction pace of 30 billion. So currently they are reducing their balance sheet every month by 60 billion worth of treasuries. There's also 35 billion worth of MBS, but that's expected to be unchanged. So of that 60 billion that they are currently reducing every month, the markets are expecting them to announce a reduction of that 60 billion down to 30 billion. So that is the broad expectations, the broad consensus for today. So that means, as usual, all the focus and the attention will be placed on the statement, and of course even more so the press conference with Fed Chair Powell, and how the actual that comes out differs from that baseline expectation. Now, the recent data has seen quite an interesting sentiment change in recent weeks. The upside surprises that we've seen in various inflation measures have seen markets price out a lot of the cutting that was priced in before that. Remember that just a few weeks ago, the markets are still pricing in about 3 cuts for the Fed, which obviously was confirmed by their prior dot plot as well, pricing in about 3 cuts, about 75 basis points worth of cutting. And now, just a few short weeks later, the markets are now pricing in just shy of 28 basis points of cuts. In other words, only pricing in 1 cut for the year. Now, that is a monumental shift from just 4 months ago, where the markets are still pricing in, 6 or 7 cuts. Look, coming into the year, we always knew that was bogus. They were never going to get to 7, not with the way the data was trading, even back then, and even less so now. But I do think that at 28 basis points, I do think the markets have gotten a little bit ahead of themselves here. It wasn't, of course, just the recent upside surprises in inflation that triggered this response. We also had quite a few Fed officials who were talking up the possibility of potentially having to consider rate hikes again. Now, it's important here to understand that they didn't say inflation is up, we need to hike rates. They basically just said, listen, we are open to the idea that we might have to hike rates if inflation doesn't moderate and it doesn't move back to target. Now, as a result of the upside surprises in inflation and these comments, the markets have been, trading according to this repricing on the rate side. I mean, if we take a look across major asset classes since the most recent meeting, take a look at what's happened to the dollar since that meeting. That was the meeting, and in between we've had all of the inflation surprises, this obviously being that big one we had a couple of weeks ago. Couple of sessions ago, and the markets have traded that accordingly, right? The dollar has traded much higher compared to what we were at the prior meeting after all of those prints, after the comments. Yields have been grinding higher as well. That is the previous FOMC, big move to the upside in yields. I mean, in terms of basis points, from where we were at the prior meeting at 420, let's just call it 428, we're now up to 467, right? That is a lot of basis points, right? The markets have basically added, let's just call it 40-ish basis points to the upside. That's huge for the US 10-year to move, right? So again, hawkish repricing has taken place. The repricing of cuts, I think, is well in the price at this stage. And we've also seen that play out with equities as well. We were range bound for a while, but they have started to push lower in line with the market's view. We've also seen things like gold pull back, but not as aggressive, obviously. But it's important to understand that gold was driven, in my opinion, by more than just expectations for cuts from the Fed. And I mean, to be fair, it's been strange pinpointing exactly what's been driving gold as well. So not the best example, but another example of just seeing a little bit of a move lower. In terms of rate cut expectations being reduced. So I think the markets have traded accordingly after that repricing. And I mean, yesterday was quite interesting. Let me quickly go back to the dollar. Yesterday was quite interesting because we saw the dollar pushing up on the back of the hotter than expected employment cost index, despite very stretched long positioning. And why that was interesting is because it wasn't just inflation data yesterday. We had some soft data coming in for the economy, which we'll touch on in a second. In my opinion, I think this sets up this move to the upside we've had in the dollar last night, the move to the upside in yields, that has dissipated a little bit. The downside we had in equities, I do think this is potentially setting up for the Fed to disappoint the markets. If we get the Fed disappointing the markets by not giving the markets the hawkishness that's already priced in, that could risk a serious move to the upside in risk assets and downside in the US dollar if they don't sound as hawkish as the markets have already priced them in to be. Because remember, the recent data, it hasn't just been all about inflation data surprising to the upside, but also growth and labor data surprising to the opposite side. Instead of those ones surprising higher, we've actually seen data surprising lower for both growth and labor. Now, it's worth noting that we've looked at this data quite a lot in the last few sessions. It's not just obviously been, it's been mostly soft data, but it hasn't been just soft data, right? We've had a couple of other, let me just show you guys here. It hasn't just been soft data. The majority has been. So for example, if I can just get this thing to open up. Come on, Refinitiv. Why are you doing this to us? Here we go. So all soft data, NFIB plunging. That's the hiring plans. Obviously, that's looking at labor. That's looking at growth itself. If you take a look at the Chicago PMI, massive amount of downside. You've got consumer confidence, massive amount of downside. We had the flash PMIs, the S&P Global, downside manufacturing, downside for services. And obviously today we had a downside surprise in the manufacturing PMI, as well as new orders. Employment staying in contractionary territory, and both manufacturing and new orders moving into contractionary territory as well. So all of that is soft data. But we've also had hard data points like Q1 GDP also surprising to the downside. So we can't just say that it's just soft data, let's ignore it. No. There's been some hard data points surprising to the downside as well. And GDP obviously qualifies as a pretty important one in that regard. So the bottom line is, we've had a few stagflation prints in the mix with inflation higher, but at the same time, growth and labor data has surprised to the downside. So when we consider that the Fed has a dual mandate, which doesn't just look at inflation, it looks at inflation and labor, I think there's a real risk that the markets have once again hawked themselves up just like they did at the prior meeting, which also provided a great opportunity to short the dollar when the Fed didn't change their dot plot as markets expected them to, right? So I think there's a real risk that we see the same type of reaction, not maybe as punchy as we did last time, but just because of all of the repricing, if the Fed doesn't give the markets that hawkish expectation that they're expecting right now, then that could see some very good reversal in some of these moves. I think the only rational option, if it was me, after looking at all of the data, is for the Fed to simply acknowledge both and say, listen, we remain data dependent. For example, they can say, yes, we've noticed higher inflation, and that is a concern for us and something we are monitoring. And yes, we've noticed the recent softness in soft data, as well as GDP, and that is a concern for us, and that is something we are monitoring. But to then also stress that, listen, the next steps for us is not pre-planned. We don't know what the next steps are because we don't know what the incoming data looks like. And I think they will use the incoming data, they will say something like, we will use the incoming data to assess where the balance of risks are tilting and take appropriate actions if needed. So you can take that many different ways, right? If you're a hawk, if you want to be bearish equities, you're going to say, oh yeah, that's super, hawkish. They're saying they can hike. And at the opposite side, which is more where I'm leaning, if you want to be more dollar bearish, you can say, oh, no. That was pretty dovish because they're not confirming hikes. They're just saying that, they are data dependent. So I think that type of answer will give everybody what they're looking for. But because of what's priced in already, that could see some reversal. That response would go against the pre-positioning we have across major asset classes and could provide us with an opportunity to short things like the dollar and long things like equities. Not because that response from the Fed would be this earth-shatteringly dovish response, but it will sound dovish based on what is already priced in. Again, think about what the markets have done here. They've gone from 75 basis points or 3 cuts down to 1 without the Fed confirming that that's going to be the case. So if the Fed comes out and they just say, listen, we're data dependent, we don't know, then the markets will think, oh, maybe we've gone a bit too aggressive. Maybe there is some more scope for more cuts this year. And I think that'll be the best opportunity that we can go for, apart from an obviously dovish shift or an obviously hawkish shift from the Fed. Now, having said all of that, when it comes to these events, guys, what I think should or shouldn't happen really doesn't matter at the end of the day. The only thing that happens is what actually happens and how we can look to trade that. So let's break it down between trigger points to see, how we can potentially trade the event. So let's start with, let's do this. Let's start with the baseline. What's the baseline? Let's talk about the guidance on rates. I think the baseline is they remain data dependent, like we said. They will say that they are noticing recent data trends, i.e. inflation and growth, but they will remain data dependent in their approach. Again, that I think is the baseline expectation, but if we get that, that can sound dovish based on the price action that we've had. What about recent data? Acknowledging both recent upside in inflation as well as softness in soft data, and just leaving it there, saying, yeah, we've seen both of this. We are data dependent. We are looking at the data, we're tracking the data, but we are and remain data dependent. What about the balance sheet? The balance sheet, as we know, is expecting an announcement of 30 billion reduction in the Fed's current balance sheet runoff for Treasury securities, and that is set to start either June or July. Now, this one wouldn't really be a dovish trigger because that is in line with expectation. So the dovish trigger will only come from if we get these two as a baseline. Now, how can we look to trade that if we get a baseline view on rates and recent data? If that sounds dovish without being dovish, I'm going to look for equity upside and dollar downside. We'll discuss the pairs in a second. Let's look about dovish outcomes. Now, on the guidance on rate side, we know what the baseline is. So what will be dovish, not sound dovish, but what will actually be dovish? If they say that, listen, our guidance on rates is unchanged and we maintain our previous view that the balance of risks for rates are still skewed towards cuts, that'll be a very clear signal for markets that, listen, hikes are not on the table anymore. We are still focused on we still think that cuts is the highest probability for this year. That'll be very dovish, even though that isn't in itself dovish if you think about it. That'll be dovish based on what's priced in, based on what the markets have already done on the rate side. What about recent data? If they downplay the upside in inflation data as, something that's too early to jump to conclusions, that'll be something that will sound dovish from them. And if they sound more concerned about the recent soft data, that is something that'll be seen as dovish. What about the balance sheet? Now, we know the expectations is for a reduction to be announced and to start somewhere in June or July. So if they come out and they say, listen, we're not going to wait, we're going to do an early start to the balance sheet reduction or potentially planning for a bigger reduction, that'll be seen as dovish. So if they do that 30, but they do it from active this meeting, that'll be dovish. And if they do move it to announce it for June and July, but make it bigger than 30 billion, that'll be seen as dovish as well. Again, things I would trigger there or trade there would be dollar downside, equity upside. What about the hawkish side? Now, in terms of guidance on rates, if they say that the possibility for further hikes are back on the table, should inflation surprise meaningfully higher, that'll be seen as their nudge for the markets to say, hey, that hike, that cut that you've got planned for the end of the year, you might have to price that one out because we don't know. Can be cuts or hikes. The only thing we're saying is that hikes are now, it's back on the table. That'll be seen as hawkish, right? That's what the markets are waiting for today. What about the recent data? If they voice no concern about the growth in the labor data, like if he doesn't even talk about the soft data, but he says something like the committee is open to the possibility of hiking rates again because of inflation data, again, that'll be them overplaying inflation, downplaying growth in labor data. That'll be seen as hawkish by the markets. What about the balance sheet? If they are so concerned about inflation that they end up saying, listen, the recent data has given us pause in our balance sheet reduction plans, we will rather reassess this at the next meeting, that'll be seen as pretty hawkish. That'll be the market's way of saying, wow, they're not even concerned about the debt, the debt repayments and what that could mean and what that could mean for Treasury. They're so concerned about inflation, they actually don't want to go ahead with that reduction in the balance sheet. That'll be quite the surprise, and that'll be their way of just pressing that hawkish message without coming out saying we are going to hike again. That'll be pretty hawkish, right? So that's the three scenarios. Dovish, obviously, bearish dollar, bullish equities. Hawkish will be the opposite. Bearish equities, bullish dollar. The baseline, though, I'll trade as a dovish outcome for guidance on rates and the recent data. So how can we look to trade this? Well, I think it's very self-explanatory here. Super dovish or a dovish outcome, we'll be looking for equity upside. What levels will we be targeting? Implied volatility high and then back up towards 5100. What about a super hawkish meeting? We'll be targeting downside, a move back down towards 5000, which is the implied volatility low. The low going back to the 25th, and then potentially move back down to 49.50. So very simple way to look for upside and downside in equities on a hawkish or dovish outcome. Now, when it comes to gold, I don't want to be trading this higher on a baseline or dovish outcome because I just don't trust gold right now. What I would do, I'm not going to trade gold, but if I were going to trade gold, gold downside on a hawkish surprise seems like a possible move to go for. We've got risk reversals pushing lower. We've got momentum, which is bearish on gold right now. We've got sentiment, which is bearish on gold right now. Trend structure, which is bearish on gold. So that just seems like the easier way to play gold would be downside on a hawkish trigger, not looking for that as a dovish trigger to the upside. Now, what about the US dollar? Again, if it's baseline or dovish, I'll be looking for downside. I still think that outcome would be the most attractive way to trade the US dollar right now because it is massively stretched to the upside. But if they come out and they say, hey, listen, we hikes are back on the table, positioning, like I said earlier today with the ISM print, positioning probably won't matter as a short-term trade for that, right? That's something we can look to trade because that will be a big shift, right? There is room for more repricing. The markets can totally price out any cuts like they did for the RBA, and that will be bullish dollar, regardless of what they've already priced or regardless of what positioning is telling us. So downside on a dovish reaction, upside on a hawkish reaction. Now, what pairs can we trade? If it's a dovish reaction, and we see the dollar pushing lower, euro dollar would still be my favorite after the recent data that we've had. This week, Eurozone data has improved quite a bit. I think that could provide decent upside. Looking to target a move back up towards 107.20, then potentially move back up towards the 200-day, the 200 MA for the 4-hour coming in at 107.60, 107.50. That could be a good target to the upside. If it's a that's a dovish reaction, right? If we see the dollar lower, I would look for euro dollar upside. If we see a hawkish reaction and the dollar rams to the upside, I think Aussie dollar shorts or Kiwi dollar shorts will probably be the best bet, because if we do see a hawkish reaction which forces the dollar higher, it's going to force yields higher, and it should also force equities and commodities lower, which both should be negative for the high betas. So I would look for Aussie dollar, US dollar downside, especially with that move in copper. Potentially move back down towards 64.50 implied volatility low, and then back down towards 64 cents flat. I think that's, you know, possible in a session if they are hawkish enough. So euro dollar upside dovish, Aussie dollar, US dollar downside hawkish. So that's just a quick view of what we're looking at for the FOMC. Like I said, I hope that I'll be able to stay awake, but you know, it's right now as I do this is, you know, it's 2 a.m. Local time, so it's gonna be a bit of a stretch, but we'll see whether I make it. So with that said, good luck out there. As always, any questions, don't hesitate to let me know.